current research project explores the challenges faced by farmers, both economically and environmentally, in making their farm-related operational decisions.
Identifying and assessing risks in commodity markets is critical for navigating this complex and often volatile trading environment. Commodities such as oil, gold, and agricultural products can be susceptible to various price factors. Making wise investing decisions requires understanding these dangers and crafting strategies to safeguard investments from unexpected market shifts. Commodities fundamentally differ from other financial assets like stocks and bonds because their prices are directly tied to physical goods. This connection subjects commodities to influences from global economic conditions and specific industry factors. One primary risk in commodity trading is market volatility. Prices can fluctuate dramatically due to changes in supply and demand. Supply can be affected by geopolitical tensions, regulatory changes, natural disasters, and technological advancements. Demand-driven volatility is equally significant, with economic growth increasing demand and economic downturns depressing commodity prices. Geopolitical instability is another risk, especially for commodities like oil and precious metals. Concentrated in regions prone to political upheaval, financial risks associated with leverage in commodity trading can amplify gains and losses. Environmental factors, particularly for agricultural commodities, play a critical role. Regulatory and legal issues can also significantly affect commodity prices. To manage these risks, traders employ various strategies. 1. Diversification. Spreading investments across different commodities or asset types. 2. Hedging techniques. Using options and futures contracts to mitigate potential losses. 3. Constant monitoring of market conditions and using advanced analytical tools. Risk management tools and techniques include 1. Stop-loss orders. Automatically selling securities when they hit a specific price. 2. Hedging. Acquiring opposing positions in similar assets to balance potential losses. 3. Options trading. Purchasing put options to protect against stock declines. 4. Value at risk, VAR, and stress testing, quantitative tools for risk assessment. 5. Asset allocation. Strategically distributing assets across different categories. Diversification in a commodity portfolio is crucial due to the unpredictable nature of commodity markets. It can be achieved by investing across different types of commodities. Geographic spread of investments. Investing across different stages of the commodity chain. Using various financial instruments. Staggering entry and exit times in the market. Leveraging and margin trading are powerful strategies that amplify potential returns using borrowed money. While they can increase profit margins, they also introduce higher risks. Effective strategies include implementing strict risk management protocols, starting small and gradually increasing leverage, monitoring investments closely, understanding the costs involved, maintaining diversification, continual education on market trends and financial products. Insurance plays a vital role in commodities trading by safeguarding against various risks. Key types of insurance include 1. Cargo insurance. Covers loss or damage during transportation. 2. Political risk insurance. Protects against events like expropriation or sanctions. 3. Price risk insurance. Safeguards against price volatility. 4. Crop insurance. Protects farmers against crop failure. Insurance not only protects financial investments but also facilitates financing and contributes to overall market stability. Learning from past risk management failures provides valuable lessons. Two notable case studies are the 1995 failure of Barings Bank due to unauthorized speculative trading by Nick Leeson, the 2008 financial crisis, resulting from inadequate risk management in mortgage lending and related securities. These cases highlight the importance of stringent internal controls, transparent risk authority, robust risk assessment frameworks, and a deep understanding of market mechanisms. In conclusion, effective risk management in commodity trading requires a multifaceted approach combining traditional strategies with sophisticated financial instruments and continuous market analysis. By employing
Section
these tools and techniques,
Understanding
investors
commodity
can protect
risk
themselves
at the
from
heart of
downside
commodity
risk
risk
while positioning
assessment is the
themselves to
recognition of the
capitalize on
unique nature of
opportunities.
these markets.
In volatile markets, commodities fundamentally differ from other financial assets like stocks and bonds because their prices are directly tied to physical goods. This connection to tangible products subjects commodities to influences from global economic conditions and specific industry factors. One of the primary risks in commodity trading is market volatility. Prices can fluctuate dramatically due to changes in supply and demand. Section 2. Geopolitical and economic risks. Geopolitical instability is another significant risk. Many commodities, especially oil and precious metals, are concentrated in regions prone to political upheaval. Changes in government policies, trade sanctions, and military conflicts can all lead to sudden and severe impacts on commodity supply chains, affecting prices. Economic growth or downturns can also play a pivotal role in driving demand for commodities. Section 3. Financial and environmental risks. Financial risks are associated with using leverage in commodity trading. Many traders use borrowed money to amplify their trading capacity, which can lead to significant gains or steep losses. Environmental factors also play a critical role, especially for agricultural commodities. Climate phenomena like frosts, floods, and droughts can drastically affect crop yields and prices. Section 4. Regulatory risks and risk management strategies. Regulatory and legal issues also pose risks. Governments can impose regulations that significantly affect commodity prices, such as tariffs or restrictions on mining or drilling. Traders and investors typically employ various strategies to manage these risks, including diversification, hedging techniques, and constant monitoring of market conditions to predict and adjust strategies accordingly. Section 5. Tools and techniques for risk management. Risk management is essential in any financial endeavor. Diversification is a widely recommended strategy, spreading investments across various assets or market sectors to reduce the impact of any underperforming investment or unexpected market event. Another cornerstone of risk management is the use of stop-loss orders, which help traders sell off their holdings before losses become too substantial. Section 6. Hedging and options. Hedging is a sophisticated technique used to manage investment risk, often involving an opposing position to balance potential losses. Options trading also serves as a powerful hedging tool, providing protection against market downturns or volatility. Understanding and using these techniques are key to reducing the impact of unforeseen market movements. Section 7. Quantitative tools for risk assessment. Models of risk assessment, like value at risk, VAR, and stress testing, are quantitative tools that help manage risk. VAR calculates the maximum loss an investment portfolio could face in a typical market environment, while stress testing simulates extreme market scenarios to prepare investors for adverse market conditions. Section 8. Importance of diversification in a commodity portfolio. Diversification is critical when dealing with volatile commodities. By investing in various commodities, sectors, or regions, investors can spread the risk of loss. Each commodity reacts differently to market conditions, so a diversified portfolio can absorb shocks more effectively. Diversifying across commodity types, geographic regions, and stages of the commodity chain helps balance the risks and opportunities. Section 9. Strategies for leveraging and margin trading. Leveraging and margin trading are potent strategies to amplify potential returns but carry higher risks. Proper risk management, including stop-loss orders and monitoring of margin requirements, is essential. Starting small and understanding the costs associated with borrowing are also important considerations. Section 10. Insurance in commodities trading. Insurance plays a vital role in commodities trading, providing protection against risks such as natural disasters, geopolitical instability, and price volatility. Cargo insurance, political risk insurance, price risk insurance, and crop insurance all provide a necessary buffer, allowing traders and producers to operate with confidence in the face of uncertainties. Section 11. Case studies of risk management failures. Learning from past failures in risk management is crucial. The collapse of Barings Bank in 1995 due to unauthorized trading by Nick Leeson highlights the importance of stringent internal controls. Similarly, the 2008 financial crisis showed the catastrophic consequences of poor risk assessment in mortgage-backed securities. These examples underline the need for thorough oversight and preparedness for market shifts. Risk management in commodity markets requires a multifaceted approach, combining traditional strategies with sophisticated financial instruments and continuous monitoring. By learning from past failures and understanding the risks involved, traders and investors can enhance their ability to navigate volatile markets and achieve success.